Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 3 o'clock in New York. It is Tuesday, December 29th, 2015, and this is the Daily Report for Gold and Silver. We have a quiet market as we go into the last week of trading for 2015. So traders, aside from gold, which is currently trading, call it unchanged to down $0.50, we do have the rest of the precious metals complex trading higher on the day. Let's take a look at gold first. 1068.68, and it's had a low of 67.77, so we're just about $1 off the low, and a high of 75.30. So the first chart that I do want to look at today, to look at critical support and resistance levels, although they're very, very close together, first off. And secondly, we are dealing with a market that's trading in a tight, compact range, which I believe will be prevalent throughout the remainder of the week, the remainder of the month, the remainder of the year. Now, when we do that, I have pulled up a very, very short-term fib retracement. Now, the fib retracement that we are looking at is a simple fib retracement, which begins up at 1192 and goes down to these lows at 1044 right in here. When we do that, we get different levels that are pretty critical and important to the upside in terms of different areas of resistance, and let's go through them. The first real level we get is 1081. Now 1081, it's a 75% or 25, depending on which side of the fence you're looking at, retracement right in here. 1081 would be the level we really need to see the market trade and close above before we can effectively believe that these two lows at 44 and 41 are actually a double bottom that's going to hold. And if in fact the market can break through this 1081, the real level of resistance has got to be 1100. And now it comes in as a 61% retracement of this last corrective move down. And it's also an even number, meaning 1100, 1200. Those are, I call them century marks, and are critically important in terms of the psychology behind where price moves and trader sentiment. Now, the other thing that we want to take a look at is some of the Western technical studies. So I draw your attention to the bottom of the screen, and I have just put up the MACD, Moving Average Convergence Divergence. We have a fast line and a slow line. We look for where they cross, such as an area right in here, which should signal some sort of a bottom. Market does track higher, as you can see right here, tracks higher here, but then you get this market really beginning to move together. So as it moves together, and you can also see that with this blue histogram line, and the length of the line is giving you the width or distance between the two moving averages. So you can see as they begin to narrow, and you can see when they cross, that's right here. And then, of course, this is going the other way, but you're seeing them widen here, come back down, that's where they almost touch, and now beginning to widen. So gold is attempting to stage some sort of rally, but up until this point, it has not been able to. So next, we want to take a look at this same information, daily chart, but what we've done is we have converted it to a standard Japanese average or Henkin Ashi chart. Difference, of course, between the Henkin Ashi and the Japanese candlesticks is how they really fix their open and close. Highs and lows remain the same, but you use the midpoint of the prior session as your open for the current session. So that is why when you get a series of red candles with no upper wicks, it's significant, because what it says is that it opened at or below the midpoint of the prior day and was never able to trade even above that as a high, intraday high on the day. And that's the significance of having no upper wicks. And so what happens is when you start to get these upper wicks, of course, that's when you start to really see the market diminish in strength. Now, in this particular case, you had a strong rundown. Market attempted to stabilize right in here and then came down and made these lows. But as we talked about yesterday, the most prevalent characteristics of this marketplace right now is the fact that when you look at these candles, what you're seeing is alternating candle color and small body size. That tells me we are definitely sitting within a marketplace right now that's in a congestion area. There is no doubt the precious metals complex as a whole, in fact, the commodity complex as a whole, has had a real difficult time this year. Silver currently trading back under $14 at $13.95. It's up, but in essence unchanged. High $14.06, low $13.92. So you can see not very much of a range. When we look at some of the softs, palladium is up almost 1%, up 485 at 556.80, and then platinum is also trading higher this morning. It's trading up about $9 at $8.90 per ounce. Now, although gold has been trading in a tight, narrow, consolidating range, the same cannot be said for platinum. Platinum actually formed a bottom roughly at about $820 and has moved up quite eloquently from that point, just shy of $900 right now. When we look at the MACD, you can see that we had this cross roughly at the beginning of December, and the market has moved up off of those lows, and the lows that we're talking about are right here, of course. Let's go ahead and blow this up just a little bit, but you can see these lows that it hit here just below 830. When we look at our channel lines, we definitely see an upward bias to them, and in terms of projections, I think that platinum could easily, if it maintains this tact and slope, we could see it meander back to 910, 920 in that area. But it has had a pretty resilient recovery. Gold has not. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.